Hi there, and welcome to Jill's Quest for Riches. Now, in today's episode, we're going to look into how you can protect yourself against inflation, or more interesting, how you can even profit from inflation. I'm going to run through a few tips. I think I have 8 lined up for you, and we'll handle them one by one. So, if you're ready, let's go. Now, my apologies, tip number 1 and 2 are not exactly rocket science. It's increasing your earnings and cutting your costs. Now, why is that? Well, the more money you have coming in, the more you are protected against possible downturns in the economy, inflation hitting you, because you just simply have more money as a buffer, more revenues that can cushion any blows, or by cutting costs, you have less costs that can heavily eat away your margin or your buffer or your safety reserve. So increasing your earnings, cutting your costs, there's plenty of ways to do so, but we'll tackle those in other videos than this one. Tip number 3, savers are punished. Now, that's contrary to what we usually get taught in school. The correct way or the mature way to deal with money is to put enough aside every month, every year, and have a big reserve in a savings account or even in cash. But actually, inflation eats away from the value of that reserve. So cash already doesn't bring in any returns, so your cash is just worth less 1 year later than it was before, the same amount, the same 100 euro bill. And your savings account, they still give some returns, but the returns are so low these days that they usually don't even compensate for inflation. So you're still not losing money, but losing value, because at the end of the year, the amount of value that you have on your savings account has decreased compared to the year before. So that's how savers are punished. Does that mean that you should stop saving money? No, but it does mean that you should do something else with the money you saved than just letting it sit there. Which brings us to tip number 4, 5, 6, whatever, all the following tips.
Before we go any further, I just want to point out that I am not a professional financial advisor. These videos are purely based on my personal experience and knowledge in this field.
Let's look at investments that go up together with inflation, right? Where are you actually protected against the impact of inflation? Or protected is maybe a big word, but where does inflation play in your favor? Well, if you invest in stocks, these usually go up either directly through inflation. People have more money to pay for the same company, the same stock, so the price of stocks goes up. That's something we have seen in the beginning of the corona crisis when we had the stimulus checks in the States. Many people just used that money to put it in stocks. There were not more people who were selling stocks, but a lot more that were buying, so prices went up. That's one way that stocks benefit from inflation, but companies in themselves also adapt to inflation. So if the wages go up, if the price for the resources they buy go up, then the cost for production goes up, so they raise the price that they charge to their clients, and the story just continues. They adapt, but they still make money. They still generate cash. It's dangerous when you have a company that has huge debts that it still needs to reimburse, and if that debt needs to be paid back in another currency, or if the interest rate that they need to pay is adapted for inflation, then they're in a bad situation. But in any other case, companies can quite well adapt. So that's for stocks, but also buying bonds that are indexed to inflation. So you have specific types of bonds that actually protect themselves against inflation. Now, on the contrary, you want to get rid of bonds that have fixed low interest rates, because they will just lose value. If the inflation is higher than interest rate you get on your bond, then you're losing money by investing in that bond. So that's the type of thing you want to get rid of. So far for investing in financial assets. Now there's other assets in which you could invest, although it's not a typical investment, but buying stuff that keeps its value. I'm thinking buying precious metals or buying commodities, for example. These things have their own value, and if the value of your currency decreases, that doesn't change the value of the precious metal or the commodity, right? You'll just have to pay more euros because your euros are worth less, but the value of gold, the value of cotton is still the same. Precious metals, they're also very often considered as a safe haven, although it's not always the case, but in many cases when there's uncertainty on the markets, for example, investors fearing high inflation, they put a bigger chunk of their money into gold, into silver, platinum as well, I think. So those prices even spike very often, leading to a financial crisis. Now, how do you invest in precious materials? There's multiple ways you can invest in the physical goods. You can invest through financial instruments. And when you do so, you can invest by buying stocks of mining companies that mine gold and other metals and materials. Or you can buy bonds of these companies, or you can buy funds that are directly invested in the actual precious metals. I would go for the latter. Why is that? Well, if you buy it physically, there's usually transportation costs that are involved. If it gets damaged, if you lose it, if somebody steals it, maybe you need to insure it. Those are all extra costs that you can get rid of if you look at financial products. Now, there's other costs that come with that, but usually you have economies of scale that compensate for this. Now, even when we look into the financial instruments to invest into precious metals, then still you could buy stocks of mining companies, but then you expose yourself to all the risks that go with the company that you're investing in, right? The company could do bad, there could be issues with their employees, there could be issues in the country, there could have high debt. So there's multiple ways that you could still have a negative impact even though the price of gold is going up. So ideally you eliminate that and you go for funds that are directly invested in the actual resources, the actual precious metals. So funds that hold a huge quantity of gold or silver or a combination. I also want to mention that some people even don't consider it as investing, it's more diversifying your portfolio. Why is that? Because in long term it's not necessarily a thing that always goes up. Contrary to what we say about stock markets, in the long run, on average, they go up. That's not necessarily the case with precious metals. Next to buying precious metals, you can also buy commodities. Now, what are commodities? These are basically the things from which we make other things. So this could be cotton, wool, oil, metal, you name it. All the other types of materials that are usually the basic components from which you build other things. Now, again, just like with precious metals, you don't want to go out and buy an oil barrel and store it somewhere in your house. No, you preferably have a fund that is invested in a huge quantity of oil or other commodities, and you just have the financial instrument that is linked to it that you can buy and sell. You also don't want to be investing in individual commodities because individual commodities can still fluctuate strongly or heavily. For example, you might say, okay, let's put money in wood, but then there's huge wood fires, and then okay, that's good, the price of wood goes up, but it could be that there's no regulation and that the price of wood goes down, or there's new countries that supply a different type of wood on your market. So there's again a lot of things that can still play for each individual commodity. So what you want to do is invest in a basket of commodities, something that has oil, cotton, wood, all the shebang in one and the same financial product. Again, putting money in commodities is good for diversifying your portfolio, but it's not the best long-term investment. Just like with precious metals, these things fluctuates, can go both up and down in the long run. It's not like company stocks that always go up in the long run, on average. Next thing on the list that you can buy is real estate. Why is that? Well, first of all, if you buy, let's say, a house, then the price of that house goes up together with inflation, right? It just corrects for inflation. If money is worth less, the house isn't worth less. You have to put in more money to buy the same house. So you want to buy it before inflation hits, of course. Then when you rent it out, you can, or you should at least in your contract, make sure that you can adapt the rent to inflation. So if there is inflation, you just ask for more rent. So you're protected there as well. And ideally, you find a good way to leverage this investment in real estate with a good loan. Now, talking about loans, next tip, How should you approach loans when there's inflation around the corner? Well, it depends whether you're borrowing or lending. When you're borrowing, right, you receive the money up front and you need to pay it back in terms or at the very end in a full package, then what you actually want is a fixed low rate. Why is that? Well, you still pay the low interest rate of 1%, whilst, for example, the inflation hits 2, 3, maybe 4%. So you're paying in real value, you're paying less and less money over time. The bank is actually sponsoring you. So that's a really good deal to do. For example, when I bought my house, I had a loan at an interest rate of 1.06%. It was in the very beginning of the Corona crisis. So any year where inflation hits 2% or more, which is more or less the target, I'm actually doing a good deal, and the bank is actually losing money on my loan. Now, why would the bank still borrow me that money? Well, basically because they were able to get it for an even lower percentage from the central bank. So that's how things go. And then when you are lending money, let's say to a company or in a special partnership, then what you want when you know that there's inflation around the corner, or there could be inflation around the corner, you want flexible rates. You want to be sure that whatever inflation does, that your ass is covered, that you get still a return on top of that inflation rate. And the last tip on the list concerns imports and exports. So what you should know, if you have higher inflation than other countries around you, that probably means that your currency will devaluate compared to the currencies of the companies around you, which as a result will mean that it becomes more lucrative, more easy for you to export goods to these countries, and it will become more expensive for you to import goods from these countries. So that can play in your advantage or disadvantage depending on what you do. If you're exporting goods to these other countries, good for you. If you make stuff based on products you import from other countries, not that good for you. Maybe you want to already stock a bit up front, or you want to put a contract in place that puts a fixed price or puts the price in your currency instead of their currency. Or if you have a main competitor that comes from another country and that is producing in another country, then you might have it a bit easier to compete with them, because either their margins will become lower or they will have to raise their prices compared to your product. So it becomes easier to push foreign companies out of your market when you have higher inflation compared to them. So that's it for today. This was my video on how you can protect yourself for inflation or even profit from it. Let me know what you would do in case of inflation, or how you are preparing, and whether or not you even believe that we are facing some inflation soon. Have a great one. Bye.